All right, class, welcome. Today, we're going to dive into something that's a real game changer in Canadian personal finance. It's called the First Home Savings Account, or as you'll see it, the FHSA. Now, for many of you, buying a home might seem like a distant goal, but trust me, understanding how this account works is absolutely crucial, and it's something you'll want to get a handle on now. So, here's our roadmap for today. We're going to start with the basics. What exactly is this hybrid account? Then we'll get into the nitty-gritty, eligibility, contributions, and withdrawals. We'll also cover the what-ifs, like what happens if you don't end up buying a home. And we'll wrap up with a pretty neat advanced strategy. Sound good? Let's jump in. Okay, first things first, the best way to get your head around the FHSA is to think of it as a hybrid. It's like the government's financial engineers took the two savings plans you already know, the RRSP and the TFSA, and mashed their best features together into one super account for homebuyers. So here's the official definition. It's a registered plan, and its purpose is crystal clear. It was designed from the ground up for one thing and one thing only, to help first-time homebuyers save up a down payment. And the way it does that is by giving you a huge, and I mean huge, tax advantage. It's a very specialized tool, but oh boy, the benefits are incredible. All right, this table right here, this is the key to everything. Look at this. On the contribution side, see how the FHSA is tax deductible? That's pure RRSP territory. You put money in, you get to deduct it from your income. Simple. But then, look at the growth and withdrawal columns. Tax-free. That's the TFSA's signature move. So you get the upfront tax break of an RSP and the tax-free growth and withdrawals of a TFSA. It really is the best of both worlds, all rolled into one. Okay, so now you're probably thinking, this sounds amazing, sign me up. But hold on, like any government program with tax benefits this good, there are rules. Let's dig into who exactly is eligible to open one of these. The criteria are pretty clear-cut, actually. You've got to be a Canadian resident, you have to be at least 18, and the big one, the one with a fine print, is that you must qualify as a first-time homebuyer. And this is where people can get tripped up. That term, first-time homebuyer, doesn't necessarily mean what you think it means. It's not about whether you've ever owned a home in your entire life. The rule is much more specific. It means that neither you nor your spouse has owned a home that you lived in during this calendar year or any of the 4 previous calendar years. It's that 4-year look-back period that's the crucial detail here. Now, here's another really important rule to remember. This account has a shelf life. It's not like an RRSP or a TFSA that you can keep open indefinitely. An FHSA can only stay open for a maximum of 15 years. So the second you open it, a 15-year clock starts ticking down. It's designed for a medium-term goal, not a lifelong savings plan. All right, let's switch gears and talk about the fun part, putting money in. This is the RRSP side of the family, and it's all about getting that sweet, sweet tax deduction. So the magic number for your annual contributions is $8,000. That's the maximum amount of new room you get each year. And then there's the lifetime limit. Over the entire 15-year lifespan of the account, you can't put in more than $40,000 total. So, pretty simple math, right? If you put in the max of $8,000 a year, you'll hit that lifetime cap in exactly 5 years. Now, here is the immediate payoff. This is why this account is so powerful. Just like an RSP, every single dollar you contribute can be deducted from your taxable income. So think about it. If you put in the full $8,000, and let's say your marginal tax rate is 30%, well, that's a tax refund of about $2,400 coming right back to you. That is money in your pocket just for saving. But what if you can't hit that $8,000 mark in a given year? No problem. The FHSA has a carry-forward rule. Let's look at this example with Aisha. In year 1, she only puts in $5,000. That means she has $3,000 of unused room. The next year, she gets her new $8,000 of room, plus she can carry forward that unused $3,000. So in year 2, she can actually contribute up to $11,000 to catch up. The one catch is you can only carry forward a maximum of $8,000 of unused room. Okay, so we've covered getting money in the account. Now let's talk about what happens to it once it's there, and more importantly, how you get it out. This is where we see the FHSA's TFSA personality shine through. And this is critical. The money you put in your FHSA isn't just sitting in a savings account earning pennies. No, you can invest it. You can buy stocks, bonds, mutual funds, the whole shebang. And the best part? All the growth every penny of interest, every dividend, every dollar of capital gains, it all grows completely 100% tax-free. This is like putting your savings on steroids. And here it is, the grand finale, the whole point of the exercise. When you're ready to buy a qualifying home, you can pull out every last cent, your contributions, and all that tax-free investment growth, and you pay zero tax. Nothing. Nada. Let's just recap that, because it's amazing. You got a tax deduction when the money went in, it grew tax-free, and it comes out tax-free. It's the hat trick of tax advantages. There is literally no other account like it in Canada. Okay, but life happens, right? Plans change. So it's a fair question. What if you go through all this? You open an FHSA, you save diligently, and you just don't end up buying a house. What happens then? Well, remember that 15-year clock we talked about? It's always ticking. Once you hit the end of that 15th year, the account has to be closed. So if you haven't bought a house by then, the government basically forces you to make a decision about what to do with all that money you've saved. And when that day comes, you have two basic options. Option one is, frankly, the bad option. You can just withdraw the cash. But if you do that, the entire amount gets added to your income for the year and you'll pay tax on it. Ouch. But option two is the smart move. You can do a direct transfer of the entire balance into your RRSP or RRIF. This is a tax-free rollover. No immediate tax hit, and get this, it doesn't affect your existing RRSP contribution room at all. It's like you're getting free extra RRSP space. So it basically converts your home savings into retirement savings. Not a bad plan B, right? Okay, for this last section, I want to show you something really cool. This is a bit of an advanced strategy, but it's where you can really see the power of this account. We're going to look at how you can combine the FHSA with the old school RRSP homebuyers plan to basically supercharge your down payment. And the best part is, this isn't some loophole. The government explicitly designed the rules to allow this. You are absolutely 100% permitted to use both an FHSA withdrawal and an HBP withdrawal for the very same home purchase. But, and this is a huge but, there is one massive difference between the two withdrawals that you have to understand. The homebuyers plan, the HBP, is really just a loan you're taking from your future self. You have to pay that money back into your RRSP over 15 years. The FHSA withdrawal, though, that's a true withdrawal. It's a gift. You never, ever have to pay it back. So let's just do the math on this because it's pretty staggering. A single person could get their full $40,000 plus all its growth out of their FHSA. Then they could also take out the maximum $60,000 from their RSP using the homebuyers plan. Add that up, that's $100,000 for a down payment plus growth. And it all came from tax-advantaged accounts. Now imagine if you're a couple and you both do this, the numbers get very, very big, very fast. So that's our deep dive into the first home savings account. As you can see, it's an incredibly powerful tool. It's probably the single biggest change to the savings landscape for young Canadians in a generation. And that leaves us, as students of finance and economics, with a fascinating question to think about for next time. How is a tool like this going to shift the financial priorities for an entire generation? What does it do to that classic dilemma of, do I save for a house or do I save for retirement? Ponder that. We'll pick it up there next class.